All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm your host, Anthony Scandariato with Red Knight Properties. And today we have a special guest, Scott Meyers. Scott is the founder of Kingdom Storage Holdings. He's a very experienced self-storage syndicator. So on this show, we talk a lot about multifamily. We're still going to talk about multifamily syndications, but we're going to talk about the differences between multifamily and self-storage, if there is any differences. But Scott has a pretty interesting background. As I mentioned, he's the founder of Kingdom Storage. He's acquired, sold, developed, and converted over 30 facilities totaling over 12,000 units and over 2 million square feet of storage. He has a self-storage education company as well, Self-Storage Profits, selfstorageinvesting.com, since 2006, and has raised over $40 million for syndications and private equity partnerships for self-storage. He's also got his own podcast, which is the Self-Storage Podcast, who would have thought? And we're happy to have him on the show. Comes with a great background and great experience. So I'm excited to hear about your journey, Scott. So thank you.
Thanks for having me, Anthony. How are you today?
Doing great. So tell us how you got into self-storage. Was that your first path into real estate, or was there a prior path? How did this happen?
Now, I think like most folks, including yourself, when we get involved in commercial real estate, you don't come out of the gate in commercial, at least most folks don't. So it started with single family houses. So bought and rehabbed, refinanced, and then it was renting these out. So the BRRRR method, essentially, with lease options, and hoping that some of these folks would actually purchase the buildings, but rarely did they ever do that. And so we were left with then having to do another rehab and move another renter in there with a lease option. And did that for a number of years, had about 75 to 78 single family houses. And then the cash flow wasn't where we wanted it, didn't have the free time that I was looking for. So we decided to get into multifamily. And so we bought several smaller, 30 to 70 unit apartment complexes, multifamily around central Indiana where I live. And that was going well. We did syndicate a couple of those, but at the end of the day, we realized that, slugging it out in the multifamily world until you get to that place with true economies of scale, having larger facilities with a professional management company. And we had management companies and we had property managers, but there was just a lot of day-to-day that still involved myself, decision-making, and having to keep an eye on a lot of contractors and property managers and companies. And so I thought, well, I certainly don't want to get out of real estate. I for all the reasons that we love real estate, it appreciates. We can borrow money to buy it. It depreciates. And when you put tenants in, they pay down your basis and pay them off. I just didn't want to wait to slug it out long enough to get to that place. And so I thought, well, I can either, if as they say, real estate's great, right, Anthony, except for tenants. And so, what's left? That's parking lots and self-storage. And so I began looking into self-storage, into the asset class. And I really liked what I saw in the metrics, how well it worked, how it was very recession resistant, inflation resistant. And, when people moved out, or if they didn't pay, we could, put them into what's called an overlock situation, where we literally overlock their unit, we put a lien on it, and then we sell it like they do in the TV shows, and we recoup our back rent and late fees. And so the more that I learned about the industry, the more I got intrigued, bought my first storage facility, and then never looked back. Through the years, we've wound down and sold off the houses, some individually, some in groups, and then same thing, the multifamily just kind of ran its course. We held on to them, following our plan: buy, create value, and then sell. And so that's what we did with our apartments, and then just never went back to really buying any. We got really, really good at self-storage. And for us, it seemed like the story was a little bit easier to tell in terms of raising capital, because it was an asset class where it wasn't susceptible to some of the challenges that we had in habitational real estate, and again, very recession resistant and inflation resistant, that we felt this was the route to take. And so that is what we've done ever since 2005. So about 15, coming up on 16 years now in self-storage, and that's all we do. We've done office buildings, and we still do some industrial and a few different things along those lines, but and making one shift to the other, it's all in self-storage right now.
Awesome. So when you're looking at obviously you've been in single family, you've been in multifamily. So when you're looking at the risk adjusted returns from multifamily to self-storage, how
Mhm.
different are they for, and I'm not sure what type of deals are you doing in self-storage? Are they core? Are they value add? Are they opportunistic? I mentioned you did a few development deals,
Mhm.
so or conversion deals. So can you tell
Mhm.
us about the risk profile?
Yeah, I think it's all of the above. Essentially, I mean, if you get to a place where you can only grow so much with your own cash, and you begin to syndicate, when you syndicate, that's a whole different ballgame. Everything's a value add, no matter what. So it's either a very poorly run self storage facility that we're turning around in a 2 to 3 year time frame, and then creating a 2x multiple in return for our investors, or the ultimate in value add is to buy a piece of dirt and then put an income stream on it, build a self-storage facility, and then create the income stream, and then in 4 to 5 years then either refinance and or sell to get the IRR, the required IRR that our investors are looking for. So in terms of looking at risk adjusted, we had a harder time, I think, finding the multifamily that allowed us to really hit those marks consistently, as well as in a fashion that is really, once again, recession resistant or inflation resistant. So, multifamily is a little more susceptible to outside forces, economic forces, versus self-storage. We actually thrive during a downturn. Self-storage does better during a recession. We've done better during the pandemic. We've outpaced most of the other asset classes because it is an essential business. And when businesses downsize or individuals downsize, they put their items in storage. As we're heading into the throes of a recession again, we've been preparing for this since 2012, knowing since this is our third recession, what happens in this sector. So for us, it was no longer really trying to eke out those returns or try to hit those or match where we had, because we realized that rents do go down in apartments, and they typically go up and continue to go up at 2 to 3% clip in self storage. Whereas underwriting, if you look at the cyclical nature of multifamily and even single family during a recession, rental rates actually go down. They take a dip, and so then you have this curve where you need to do the makeup on that on the back end and hope we get the returns to our investors. And so from that standpoint, we just all based on stats, not a lot of it out of experience, but also based upon stats, just knowing that we put ourselves in a better position to be able to hit the marks for our investors in industrial and in self-storage than in the other asset classes we were investing in.
Sure. So definitely makes sense. Um, how do you find self-storage deals? I've had, I'm not saying I look for them, but I know that I come across them every once in a while.
Mhm.
But how do you, I mean, do you find them through the same channels as through your regular commercial real estate brokers, or are they off market more of? Is there more inventory? Because obviously there's a lot more apartment inventory, if I had to guess, than self
Mhm.
storage in this country. So,
Mhm.
wh- what does that look like in terms of the capital markets and the deal flow side?
Sure, sure. So, the strategy is really not much different, Anthony. It's going out to the brokers, to the commercial brokers, and really to the self-storage brokers. A lot of the larger houses like Marcus and Millichap, CB Richard Ellis, Argus, there's companies that specialize in self-storage and self-storage only. And then the bigger commercial houses, then they have a division or an arm that specifically relates to self-storage. So creating those relationships with those folks, telling them what we're looking for, that we're looking for the real difficult turnaround deals that their buyers list may not want, or that are difficult to fund, but we can get across the finish line because we have private equity. We can take them down a lot easier. Direct mail has still been a good provider for us, so no different than multifamily in that nature, that we're buying lists, acquiring lists, and then curating and scrubbing those over and over and sending mailers out on a regular basis to those owners. And that, in hopes that when they are ready to sell, that they are not going to go the broker route, but they will answer our letters, or at the very least give us a seat at the table to see if there's a way that we can work out a project. With self-storage, there's also a lot of these mom and pop owners feel as if, well, not feel as if, they know that they own a business and real estate. It's both. And so when it comes time for them to sell, many times they will contact a commercial business broker, or they'll list it on a business brokerage website versus the traditional real estate circles or even self-storage. And so we comb, that entire side of the industry, looking for those folks and those listings that are on the small business side of the house versus on real estate. and then canvassing and pulling on doors in the markets that we're operating in, as we're doing our market analysis. And certainly after we close on a facility, then they're really hitting that market to try to get even more economies of scale and buying up the competitors in the market as much as we can when they are ready to be able to sell. So, there's about 10 different ways that we are looking for facilities and marketing, but those are the main ones. And as you mentioned, we have an education company, so I have a lot of students, a lot of folks that we have trained, and people that we consult with, that we teach them how to go out and find and market these facilities. And so many times they find either too many deals that they can't take them all down, or some of these projects are too large, or they need to have a partnership or do a joint venture for credit purposes or equity for us to bring equity to the table. And so we have a lot of deals that get presented to us in that fashion. And just being active, no different than the syndication side. I write a lot of articles. I speak for the trade associations. And so our name is out there, our company's name is out there. And just by nature of being present and doing the exact same things that you're doing, Anthony, deals land on your desk when people know about you and what you do.
Sure. Can you talk a little bit about the metrics that may be a little bit different and also similar to multifamily? So multifamily, we look at price per unit, cap rate.
Yeah.
Are all those same metrics apply to self-storage?
Yeah, as cap rate's kind of the leveling field for anything. It's NOI and applying a cap rate, and some of that is geographically specific, depending on parts of the country. But mostly, it's tied to the interest rate right now, and all relates to the yield. What type of a yield you're getting in terms of an investment. So that is roughly the same right now, with the exception of self-storage right now in terms of cap rate. Versus the NOI and sales price right now. We just saw a report that came out last week by Yardi, which is the largest data gathering company in our industry, showing a yield spread of 620 basis points in self-storage, which is outpacing all the other asset classes in terms of return on investment. And so, again, we're very bullish on storage, and those are the metrics that we follow in terms of the cost of capital, the yield that we're getting on our, in returns on our money. But then on the syndication side of the business, as you know, we're in the money business. It's just, we're putting out projects to our investors and to our database. And it's up to them to then choose to say, this project is 5 years long versus this one that's 3 years. There's an equity multiple of 2. This one's 1.95. And a preferred return may, in returns that are happening a little sooner, distributions that are coming a little sooner, those are all factors that allow us to raise the capital and get people involved in our projects. And so we're always cautious of what we're putting out there in the marketplace. And so from that standpoint, we have the ability to find some strong projects and raise the capital very quickly, because we have once again, the benefit of having that large yield spread in self-storage right now, which allows us and our investors to make money a little bit easier in self-storage than we had in the other asset classes.
Okay. When you're talking about self-storage and financing, so how are these deals financed differently than multifamily? Because multifamily, you have agency debt, Fannie, Freddie, local bank debt. How is self-storage typically financed? Is it similar or different?
It is very, very similar, with one exception. In terms of straight commercial debt that we're looking at right now, for the most part, we're going to 2 or 3 places. So one being, if it already has debt on it with a bank, a local bank, credit union, we're obviously going to go back to them to see if they want to underwrite it. The community banks, credit unions, the 1, 2, 3, 5 branch banks in those markets, the small business bankers, they love self-storage to portfolio it, because again, it's strong for their balance sheet, because it does very well. They can understand it. It's a simple, predictable business model, does very well during a recession. So those folks are gobbling it up. We also have the SBA, which has the 504 and the 7A programs. And the SBA these programs are only available to self-storage because the SBA is a small business lender. And so they recognize self-storage as a small business. And so they will go up to 85% LTV. They have a 650 credit score is what they're looking for. But all along the way, the rates and terms are more beneficial that we see with the local banks, because they're in the business of getting money out into the market to grow businesses and to grow jobs. And so from that standpoint, it's another feather in our cap, if you will, in this side, that allows us to get higher LTV and at lower rates, and with folks that are chasing that. Then we've got brokers that have relationships with insurance companies, pension funds. They too are all scrambling to get a hold of storage deals, especially right now, because once again, it's very, it doesn't fluctuate very much. Does well during a recession, does well during good times. And so through the broker network and channel, we have access to a lot of different pools of money that are outside of just lending relationships in general that we have to be able to partner with.
Right. No, that makes sense. And in terms of the deal sizes, so typically, let's just say multifamily, one apartment in New Jersey costs $100,000 a door. Let's just say, what
Mm-hmm.
would one storage unit theoretically cost? I know you mentioned you're in Indiana, you said.
Yes, correct.
So, and wherever you're purchasing the storage units, like
Mm-hmm.
how is that relative, and what would be the relative rent? Let's say that unit goes for $1,000, that hundred thousand
Mm-hmm.
dollar unit. It's a one bedroom apartment.
Yeah.
What what would be relative for storage for one storage unit?
Sure. Well, and just like any other commercial asset class, if we're looking at net operating income and a cap rate, everything else is essentially irrelevant. However, because you could be paying $1 million an acre in LA and build an apartment complex that's going to generate more rent. Same thing with a self-storage facility; it's going to generate more rent versus rural Mississippi or even rural Indiana. So, a 10 by 10 in the most rural of locations could be going for $35 a month. A 10 by 10 that's whether it's non or climate controlled or non-climate controlled, and in LA or downtown Miami or anywhere else, that could be $150 a month. And so again, it all depends upon the market and what we're looking at. So cost per unit or cost per door, anywhere from $3,000 a door, on up to $15,000 a door. As low as being able to buy it for $25 a square foot or less, to over $125 a square foot, all dependent upon class A, B, or C and what market it's in. So I don't know if that answers your question,
It
Anthony, but
does.
it is, kind of similar for all commercial real estate. It's just, very, very geographic specific, and then asset within the asset class A, B, or C type.
Sure. Can you talk a little bit more about occupancy and lease up for storage? So in full disclosure, we own about 33 storage units
Mm-hmm.
and they do pretty well. It's
Mm-hmm.
actually in conjunction with one of our multifamily
Yeah.
properties
Mm-hmm.
and it does very well. I did notice that it does take a little bit longer to lease than apartments, at least in my property. So I don't know what your experience is. The average occupancy is a little bit lower than the 95 on the multi. It's maybe around 92 or
Mm-hmm.
so on the storage. What has been your experience?
Yeah, so let's tackle that one first. In terms of average occupancy across the country right now, yeah, right around 92. I think 93 is what I've
Yeah.
seen. We underwrite, and most banks accept and underwrite at 85% being stabilized. If it's a Class A facility, then it should be 90. And that's what we do for underwriting purposes. So that keeps us conservative with the banks as well as with private equity. The good news is that the average break-even occupancy for us is right around 67%, whereas with multifamily, at least when I was in it, was somewhere around 82%. So 82 to 95 is a smaller spread than 67 to 90. So in terms of lease up, what we were seeing is, again, all dependent upon the market. If we've done our homework on a development project, we should be, plugging along at 20 to 30 units a month during a lease up. And that's net, because you may have 35 or 40 move-ins and then have some move-outs, because it is a little bit more fluid. Our leases are 30 days long; they're not 12 months. However, our average tenancy is anywhere, depending upon the site, is anywhere from 9 to 13 months on average. So some projects go a little slower than others. It's usually dependent upon the market and what type of marketing that we're doing, and pricing all figures into that. We also take a little bit of a dive through the winter, but then extreme lease up in the springtime again, when people are moving and doing different projects and what have you. So we have a little bit of a cyclical nature, but it doesn't fluctuate too much throughout the year.
Got it. Could you talk a little bit about the management? So you mentioned that you do month to month, basically month to month leases,
Hmm.
is what I'm gathering.
Hmm.
So in self storage, is there like an on-site? How do you staff these properties?
Hmm.
Is there an on-site leasing team? How does that work?
Yeah, couple of ways that we can go. We use third-party property management companies, and they in many of our facilities are Class A facilities that are, anywhere from 500 to 1,000 units. So we typically will have 1 to 1.5 staff on site, and that's because at those sites it generates a lot of activity. But we also, one of the goals is to generate more revenue and drive that NOI by offering ancillary income streams. And so renting U-Haul trucks, that person behind the counter is really a salesperson as well, like a property manager, or the sales associate behind the desk in an apartment complex, on whether they need insurance, selling locks, boxes, and moving supplies, and any other services. Our boats and RVs, they can get detailing services, they can have concierge services. There's a number of different ways that we can drive that average rental up, and it makes sense of having that person in there. Now, the beauty of our industry is that we can also rent units at facilities that are unmanned. We can have a 1,000-unit facility that is completely unmanned, and a kiosk is basically handling this. We're in that place now where we have an office that is really small. Now it's more like a vestibule, and when you walk into the office, it has the sizes of the units built out, a 10 by 10, 10 by 15, 10 by 20, with a video monitor inside that shows what will fit inside each one of those. And then they walk up to one of two stations that are a kiosk, but it's basically two iPads on a stand connected to the property management software, and then a video monitor that connects to a call center, so that if they have a question in the rental process, that they can hit a button and they can be contacted with the call center. But everything is done by way of either a smartphone now from a responsive website, or if they walk into the facility, everything is done by way of a kiosk and utilizing technology. I mean, it's a very low labor intensive type transaction anyways. We don't really have to have a salesperson like an apartment complex where they want to walk around, they want to see the various units, they want to know about the school system. We're talking about a commodity. It needs to be safe, clean, secure, close by, and they need to be able to check this off their list of things to do that day. And if we make it easy for them to do, instead of having to shop around, people don't shop around for storage units. If it fits their criteria, they're 90% of the way there by the time they've already looked on their phone at your website. And if they can reserve a unit and rent it by way of their phone, or coming in and utilizing a kiosk 24/7 to be able to rent a unit and move their stuff in or out, that's what usually wins the day. So we have unmanned facilities, we have fully staffed facilities, and we have a blending of both, so that after hours they can come in at any time and they can rent a unit, make a payment, do anything that they need to, just as if there was somebody there inside the office.
Interesting. So let's talk a little bit about, you mentioned the eviction process a little bit for self-storage units. Would you say, what would be the average collection loss on a self-storage project of yours? Now, it doesn't have to be yours, but just in general, because you got to think about, like you said, I forget what was the term you used? What is it called?
So it's a lien law that we go through. We have
Lien
the
law.
protection of the lien laws, and what's called an overlock situation, which is part of this whole process. So we don't have evictions. That's the beauty of self-storage, is we have the protection of the lien laws. So eviction and eviction laws protect the tenant, whereas lien laws protect us. And this is probably, Anthony, the single biggest reason why I made the switch to self-storage. We manage to 5% of our rent to be outstanding beyond 30 days. That's our goal, is to have no more than 5% of our rent outstanding beyond 30 days. Well, with the lien laws and self-storage, on the 6th of the month, we lock our units down. Either at old style, the manager would go around and put an overlock, round disc lock on the units. There's a place for two locks, one for the clients, one for ours. Nowadays it's all electronic, so we've got locks on the insides of the doors, and it just at the 6th of the month, property management software knows that they haven't paid, it locks them down. And the only way to get into their unit and get their stuff is to pay. There's no other way to get into that unit. And so either they pay, and with late fees, so we get 100% of our late fees, no questions asked, because they can't get into the unit until they do. So that's the only time it's unlocked. And if they don't, and they go AWOL, they're gone for 60 or 90 days. In almost all states, it's a 90-day process. And after 90 days, we've advertised, we've gone through the process of getting certified mail. But if they haven't, then we have the right to take their lock off, open it up, and auction the unit off. Again, like auction hunters and storage wars, like you see on TV. The process is very similar. And so we sell their unit off, and we recoup our back rent and our late fees. And so from that standpoint, we get to control it. We are the judge, we are the jury. We don't have to go to small claims court and have the judge rule in favor of the tenant, as they did over and over and over again. There's no questions asked. And in many cases, we sell it for more than what was owed, and we send that money even back to the last known name and address. In some instances, it's less than what was owed in back rent and late fees, but at the end of the day, after 90 days, I'm recouping almost all of it. And then when the auction is done, that person moves everything. Either they move it out and they blow it out before we give them their deposit back, and we're ready to re-rent it within an hour. Or when they buy it, they may keep it there for a while and then piecemeal it off to sell it. And in that case, then we've created another rental immediately. So the day that we sell it, if we got full price, it's rented again immediately by somebody else, and there's no gap. And so when we begin to run our numbers in terms of collection loss, and we were averaging about $1,300 to $1,500 a turn in our apartments, to lost rent, get it leased up, clean carpets, replace carpets, and what have you. And in storage, it is a fraction of that because we release it immediately. We blow it out with a blower. It's a concrete slab with a metal box on it, and we've been able to recoup our money by way of the lien laws and collecting through a sale. So that alone was worth the price of admission for us to make the switch over to self-storage.
Sure. And how long? So do you have a partnership with like different auction houses that you work with essentially, or?
We will. So we'll bring some of those folks in at the smaller facilities. Our managers can do it. The lien laws are very specific in every state, and we have forms for each one of those, and we can handle that internally. But typically, we do outsource that and have somebody else handle it. Plus, now recently we're doing it online. We can open it up, we can take pictures and put it online, and everything is completely legal. We follow the letter of the law, and everything is stated, so that we don't have to have an auction and we don't have to hire a company to do it. We take pictures and then let the bidding wars begin online, and then they show up and take their goods out once they've paid in full for the unit, and they clean it out.
Interesting. And so I guess your staff kind of deals with that for the most part, but it sounds situational and property specific, right?
Correct. Yep. And I have no hand in that. So the property management company handles any and all of that.
Awesome. So what's next for you, Scott? Are you looking at your underwriting deals now? Are you looking at buying more? What's the next step for you in your business?
Yeah, so we've got development projects coming out of the ground right now. We're not looking at those as heavily because the banks have they've kind of peeled back the rates and the terms aren't as favorable on speculative type deals, just like they always do when we head into a recession. So we're looking at more existing facilities turnaround that may be just mismanaged. In the path of progress that could use expansion, or whether the owners have just they've just run out of capital and they're scared of competition. They may be scared of the looming recession or COVID or what have you, and being opportunistic, as you mentioned at the top of the show, looking for those projects that come along that have a value add component that we can raise the capital for, put the capital into, and turn the projects around and either refinance or sell.
Excellent. How can people find you, Scott? I know I mentioned a lot of different avenues, but why don't you tell our audience?
Yep. You can find us on LinkedIn and on Facebook, but to find out more about what we're doing and to kind of get a little peek behind the curtain, you can go to passivestorageinvesting.com, and talks all about what we're doing on the syndication and the development and acquisition side of the house. And then also a free report that we're giving out to folks just to try to level the playing field as well, and not have so many newbies out there bidding against us, by giving them some education and teaching them about the mistakes, the 7 mistakes that new investors make in self-storage and how to avoid them. So you can head on over to passivestorageinvesting.com, pull that down, take a look at what we're doing, and I'd love to have a conversation or chat with anybody if we can help in any way.
Excellent, Scott. Definitely encourage our listeners to download that free ebook. Since Scott is giving that away for free, take advantage of it. And if you could please go on iTunes and rate and review our show, it would tremendously help our rankings and to help Scott and myself get our message out to more viewers. So we would appreciate if you did that. And we'll have a link to Scott's website as well as his podcasts in our social media description on iTunes. So you can feel free to check out Scott's content, because he has a lot of it and it's all good for information whenever you get the chance. So again, want to thank Scott for spending his time with us today on the show, and hope to have him on again in the near future.
Yeah, it's been an honor, Anthony. Thanks so much.
Thank you.